Hello and welcome to today's video. It's been 6 months since I last had a clean up of my portfolio, and I thought it was about time to take another look to see if it's still meeting my needs. My long-term goals are to see steady growth but as ethically as I can. Not the easiest tightrope to walk, but I'll give it a go. My main issue at the minute that I can see when I look at my portfolio is that my investments have been lacking focus. I've got quite a few funds that I still hold relatively few units of, and although this isn't the end of the world, it makes life for future me that little bit harder. The problem I see with this is around the snowball effect. You may have heard this term before. If you've not, it essentially refers to how your cash makes you more cash. I think it's a great metaphor that you can easily visualise. In this metaphor, the snowball you start with is your initial investment, and the snow on the ground is your returns, be it dividends or interest. If you picture a small pea-sized snowball rolling down a hill, picking up more snow as it goes, it will take a lot longer to reach a substantial size than one that is the size of, say, a football. One of the other issues that I can see is that some of these funds are crossing over quite a bit and treading on each other's toes. As most of the funds I hold are made up of shares in companies, there are a few that hold shares in the same companies or sectors. When I looked at my portfolio 6 months ago, I wanted to diversify a bit more, but things have changed since then. I still want to diversify, but I think less so by region. I think Eastern exposure is very risky at the minute. Although we may not physically be in a World War III situation right now in a traditional sense, I feel that when we look back, we might see this as a world war of resources. The world is very unpredictable at the minute, and there is a good chance it could get worse. There is still a chance that sanctions may not end up just being limited to Russia and Belarus. I've mentioned previously before about my concern for the JP Morgan Emerging Markets Fund, and when you look at the countries it's mainly invested in, you can see why. I've already taken a big hit with this fund though, so I'm going to wait this out before I chop it in. This isn't where I'm starting today though. The first fund I'm looking at is the Lindsell Train Global Equity Distributing Fund. On the surface it has some good credentials. It fared pretty well through the pandemic due to holding in companies that supplied essential goods to the consumers in well-established markets. There's a lot of big household names in there, such as Nintendo, Pepsi and Disney. The fees are relatively low as well, with a net ongoing charge of 0.5%. It pays a dividend twice a year, although with a historic yield of just over 1%, it is pretty low. The problems I see are when you start looking into the sectors and holdings. Economies are squeezing currently. I think if households start to feel the pinch even more, then a lot of these sectors could be some of the first to take a hit. The fund has money invested in brands that are considered a mixture of luxuries and consumer staples. My worry here is that in the last few years these have weathered well due to the consumer staples propping up the sales when people aren't buying so many luxury items. But if supply chains falter, then these will be in short supply too, and people may look for more budget brands as their household spending drops. Also, when you look at the holdings, Unilever and Mondelez are two brands I don't really agree with Unilever's recent response to their position on Russia being the latest in quite a long history of issues, and Mondelez, who own Cadbury, being investigated for child labour, it's looking like something I could ditch and then add the money from that sale to increase the size of one of my other pea-sized holdings. The next fund that is looking dicey to me is the Fundsmith Equity. It has performed well in the past, seeing some pretty decent returns, but it does have a high fee with a net ongoing charge of nearly 1%. There isn't even a saving grace of a high dividend with this fund, with a historic yield of just 0.27%. It has substantial holdings in Facebook and PayPal too, which are two companies that seem to be facing some serious challenges at the minute. PayPal's share price has nearly halved over the last year. A lot of this seems to be driven by concerns over where the company is heading and its inability to continue some of the market dominance it's previously enjoyed. Facebook or Meta platforms as they now trade under are suffering a very similar fate, with the share price being down nearly 40% on last year. And with there seeming to be a never-ending stream of controversy around the metaverse, it's hard to see it rising again soon. The fund on the whole is still performing well currently, but with that high charge and low dividend yield, it's just looking less appealing to me now. I think it's one that can be cut from my portfolio, and then the proceeds can be added to another one of my funds, or perhaps some individual shares. Of course, what I don't want to do is just pick funds on low fees and high dividend yields. There's a lot more to it than that. I would like some growth over the long term and limit my exposure to risk. It's all quite the balancing act. So, that leaves the question, where will I put my money instead? I'm still thinking of that at the moment, but just to make a point, if I look at one of the funds I hold, the Aviva INV UK listed equity fund, when you compare that to the Fundsmith I was just talking about, the ongoing charge is half, and the dividend yield is around 13 times higher. These aren't all I will look at when choosing to invest, as there is a lot more to it than that, but these figures are definitely a factor. I also hope this video doesn't come across as East bad, West good, because that is definitely not my belief. The world simply isn't as black and white as that to me. As always though, let me know your thoughts down below, and if you've made any changes to your own investments lately for similar reasons. That's it for today. Don't forget to leave a like and subscribe for future updates so you can see where I go from here. Stay safe out there, and thank you for watching, and I'll see you next time.